Would it surprise me if they issued it in October? No, it wouldn't. But I think it would also not surprise me if they waited another year, to your point, in 2025. And James Rickards has an interesting take on it. He says, yeah, it's all about mass adoption, that right now there's 10 countries that they can shop with if they had a common settlement currency. 10. What happens if it's 69? If they said, fine, the other 59 are in. Now you can buy goods and services from 69 countries instead of from 10, which was previously 5. And pretty soon you have such a massive swath of GDP, human population, commodities, shipping lanes, military might, that not only is it a massive, massive real entity in every single way, but then issuing that common settlement currency, it's almost 100% guarantee that it works to a massive detriment to the dollar, to the treasury market, and to the way things have always been in this country. Yeah, well, I have a hard time. I've said forever, I can't imagine that they would lower rates, and they haven't so far. I mean, remember, there was going to be 4 or 5 cuts for sure, and then, well, maybe one, and then maybe none. Maybe they're going to raise. And there's $14 trillion in debt that needs to be retired this year as maturing debt, or to pay interest expenses, or to cover the ridiculous amount of irresponsible fiscal spending and deficits of our government. How the hell do they come up with that? Maybe you can, as rates have been going down, what you are seeing is the Fed intervening already through, as Jim Willey puts it, the UK and Ireland and the Cayman Islands funneling money under the table. Because look, when you have a situation where more bonds are sold than our bought, rates rise, right? But when more supply, that's more supply than demand. But when more bonds are bought than are sold, rates fall. So we're supposed to believe that someone is interested in buying our 10-year treasuries, and they are doing so to drive rates down. I just have a hard time believing anyone would be buying our bonds right now when we see Russia and China and Japan dumping our bonds right now. I have a hard, who the hell's buying it? Is it monetization? I think it's important to remember, there it is right there. And I think it's important to remember.
He's a buyer of bonds right now, I hear.
He said, there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion, or we're not there yet, or later as a final and total catastrophe of the currency system involved. We're heading in that direction. You lower rates, you have acquiesced once again. You're just going to reignite inflation. Yeah, the numbers they tell us are all fugazi. You can't believe them. Inflation is way higher than they're telling us. And this is a politicized event by the Fed to lower rates 2 months before the election. And if they do it, fine. But I think it's stupid, and they'll never normalize their balance sheet. And it just signals to the world, why the hell would you want to sell us your oil or your commodities for a currency that once again will give in to inflation over austerity? And once again is rigged. I mean, it's rigged in every way, even in the way that they measure all of the numbers to gauge their policy decision, including unemployment numbers. And if they hired John Williams instead of the Bureau of Labor Statistics, maybe we would be able to direct monetary policy to right the ship. But what they are doing by giving in and lowering rates is the worst thing that they can do, and just giving up on ever getting this house in order. And it would start with stop spending. And the spending that we do is ridiculous. $100,000 per second is the amount of debt that we are creating. That's $1 trillion every 100 days, and not slowing down. So yeah, if you believe that inflation is where it is, I got a bridge to sell you. And that's why you take a look at all of these markets that just keep going straight up when compared against like the 10-year treasury. When you're comparing it, all of these markets are going straight up. All that money that's been created and poured into the system, whether it be gold or Bitcoin or the S&P or the NASDAQ, all of these things is shooting up because of all this money, and that will just keep it going higher. So it's good for gold. It's good for the market. And ultimately, it's not good for this country. So yeah, they'll probably lower rates, but I think it's really a dumb thing because it's only going to make a bad situation ultimately worse.
Andy Schectman eloquently highlights the dire financial situation facing the U.S. and the global economy. With $4 trillion in debt that needs to be retired in 2024, the U.S. government is grappling with maturing debt, interest expenses, and fiscal deficits. The Fed's intervention through entities like the UK and Ireland aims to manage these issues, but the fundamental problems persist. When the Fed intervenes to buy bonds, it artificially lowers interest rates. However, this creates a false sense of security in the market. The reality is that major countries like Russia, China, and Japan are dumping U.S. bonds. This raises the question, who is buying these bonds? The answer points towards monetization and covert operations, suggesting that the situation is more precarious than it appears. Ludwig von Mises once said, "There is no means of avoiding the final collapse of a boom brought about by credit expansion." This quote is pertinent as we see the U.S. attempting to manage its debt through credit expansion, risking a total collapse of the currency system. Lowering rates to stimulate the economy only reignites inflation, exacerbating the problem. Official inflation numbers often understate the reality. Real inflation is significantly higher, affecting the cost of living and eroding the purchasing power of fiat currencies. Lowering rates before elections is a politicized move aimed at short-term gains rather than long-term stability. Such actions undermine the global trust in the US dollar, making it less attractive for international trade and investments. In this context, gold and silver emerge as crucial assets. Unlike fiat currencies, which can be manipulated and devalued, gold and silver retain their intrinsic value. Investing in these metals provides a hedge against inflation and currency devaluation. They offer stability in an unstable economic environment, ensuring that your wealth is preserved. The geopolitical landscape is shifting, with countries like China, Russia, and Saudi Arabia moving away from the US dollar. These BRICS nations are increasing their gold reserves, signaling a move towards a new economic order. By holding gold instead of US treasuries, these countries are protecting their wealth from the volatility of fiat currencies. This shift is significant. As these countries accumulate more gold, they increase their economic independence and influence. The US, meanwhile, continues to print money and accumulate debt, weakening its economic position. This dynamic creates a doom loop where the West becomes increasingly dependent on BRICS nations for commodities and other essential goods. The BRICS nations are also exploring the creation of a common settlement currency backed by gold. This move could dramatically alter the global financial landscape. If successful, it would undermine the US dollar's dominance and establish a new standard for international trade. The longer the BRICS nations wait to introduce this currency, the higher the price of gold is likely to rise. For individual investors, the current economic and geopolitical trends underscore the importance of diversifying portfolios with physical gold and silver. These metals provide a reliable store of value, protecting against the devaluation of fiat currencies. Investing in gold and silver also aligns with the strategies of central banks and major economies, which are increasing their reserves of these precious metals. Investors often have concerns about storing and liquidating physical gold and silver. Secure storage options include home safes and professional storage facilities, ensuring the safety of these valuable assets. Liquidity is another common concern. While gold and silver are not as liquid as fiat currencies, they can be easily converted into cash when needed. Numerous dealers and platforms facilitate these transactions, making it straightforward for investors to access their funds when required. The strategic accumulation of physical gold and silver is essential for protecting wealth in today's volatile economic landscape. These metals provide stability and security, ensuring that wealth is preserved regardless of economic conditions. By understanding the broader economic context and taking proactive steps, individuals can safeguard their financial futures. Investing in gold and silver is not just about short-term gains, but long-term security. These metals have a history of preserving wealth over centuries, making them reliable investments for future generations. By staying informed, diversifying portfolios, and preparing for economic shifts, individuals can position themselves to thrive in a rapidly changing world.
We're all aware that China and now even Japan, to a degree, Russia, Saudi Arabia, they've all been selling bonds. Let's just say the BRICS nations have been selling bonds, right? At the same time, arguably, they're buying gold, which we can see. At the same time, the United States and the United Kingdom and these Western nations that we're supposed to believe are buying our bonds are going further into debt. We're going further into debt buying government debt. They're buying our debt, the UK is, and we're going further into debt in order to buy commodities like oil and energy production from the BRICS countries, who instead of, they sell us their oil, and what are we doing? What are they doing with the proceeds? They're buying gold. Instead of putting it into treasuries, they're buying gold. And we're creating more debt in order to buy energy from these countries. They used to buy our debt, but now they don't. So we have to sell that debt to the UK and to the Cayman Islands and Ireland, if you believe that. But this is a doom loop in the respect that these BRICS nations continue to pile into gold and other commodities with the proceeds of the energy we buy from them and the commodities we buy from them, which only pushes those prices up higher. And when you talk about gold going higher, as part of the new BRICS currency settlement, which will be deliverable, this just falls right into the hands of the BRICS countries. So the longer they wait, the higher the price goes in gold. And the more reliant the West is upon them for these commodities. And at the same time, you have a massive growing mass. 59 more countries said they want to join, coming out of Novigrad 2 weeks ago. This is something that when you have more and more and more and more countries sign on officially, all accepting a common settlement currency that is not US dollars, that is settling in essence in gold, which is 40% gold, which is deliverable, which is held within the own borders of these countries. And that's a very important point here. If you in the unit white paper, it talks each one of these countries will hold their own gold. So when you see this mass repatriation effort, and in particular, India is a good example, repatriating 100 metric tons they've held at the at the Bank of England, B of E, Bank of England since 1991, and all of the countries repatriating their gold from the New York Fed. Well, that makes sense. These countries understand they can hold their own gold. They'll continue to buy gold because it will be what they settle in, which has outperformed the bond market 2-to-1 over the last 25 years with no counterparty risk. So the longer they wait, the more countries join on, the higher the price of gold is going to go, and the more trouble that the West will have in I think finding natural resources and people willing to hold their debt. So
this scenario underscores the growing importance of gold and silver as strategic assets in the face of evolving global financial dynamics. The actions of BRICS nations and other countries indicate a deliberate move away from reliance on the US dollar and its associated financial instruments. Instead, they are positioning themselves with tangible assets that provide stability and security in times of economic uncertainty. Central banks and governments worldwide are recognizing the limitations of fiat currencies and the benefits of holding physical gold. By repatriating their gold reserves and accumulating more, these countries are preparing for a potential revaluation of gold. This revaluation could significantly alter the global financial landscape, shifting power dynamics away from Western economies heavily reliant on the dollar. For individual investors, these developments highlight the necessity of diversifying into physical assets like gold and silver. The traditional financial system is under strain, with increasing debt levels and declining confidence in fiat currencies. Holding gold and silver provides a hedge against these risks and offers a stable store of value that can withstand economic fluctuations. The recent trends in central bank behavior and macroeconomic indicators suggest that the value of gold and silver will continue to rise. Countries like China and India are leading this shift, with significant increases in their gold purchases and strategic moves to secure their economic future. This trend is likely to continue as more countries seek to protect themselves from the volatility and risks associated with fiat currencies. Since 2008, the global financial system has increasingly relied on money printing with diminishing returns. The confidence between banks has eroded, as evidenced by the decline in interbank lending. Central banks have lost confidence in each other, highlighted by the Swiss National Bank's surprise actions in 2015. More recently, confidence between central banks and Wall Street has faltered. The final layer of confidence lies with the public, and if that erodes, the consequences could be severe. Public confidence is crucial. Those insulated from the immediate impacts of inflation might not feel the urgency, but for many, the rising cost of living is a significant burden. As monetary velocity, the rate at which money changes hands, increases, it indicates a shift in economic behavior. People are rushing to spend their money while it still holds value, a sign of the early stages of hyperinflation. As these economic dynamics unfold, the value of gold and silver becomes even more apparent. These metals provide a tangible, reliable store of value that can withstand economic fluctuations. They offer security in times of uncertainty, making them an essential component of any robust investment strategy. For individual investors, the lesson is clear. Diversifying into physical gold and silver is not just a hedge against inflation, it's a strategic move to protect against broader economic risks. The actions of central banks and the macroeconomic trends provide a clear roadmap. Following this roadmap can help investors safeguard their wealth and ensure long-term financial stability. The dynastic wealth concept, as taught by Jim Rickards, emphasizes the importance of assets that have stood the test of time. Real estate, rare collectibles, and gold form the pillars of this strategy. However, in the current economic climate, gold stands out as the most versatile and reliable of these assets. It provides a foundation upon which other investments can be built and offers flexibility in times of economic distress. Real estate, while valuable, is subject to market fluctuations and heavy taxation. Rare collectibles, though precious, can be illiquid and challenging to value accurately. Gold, however, is universally recognized, easily divisible, and has consistently preserved wealth through centuries of economic changes. It is this reliability and universality that make gold a cornerstone of any robust wealth preservation strategy. Moreover, gold provides a way to accumulate other forms of wealth when they are undervalued. During economic downturns when real estate prices drop, gold retains its value and can be used to purchase properties at lower prices. Similarly, rare collectibles can be bought with gold when the market for such items is depressed. This flexibility makes gold a cornerstone of a robust wealth preservation strategy. Understanding the broader economic shifts and positioning oneself accordingly is crucial. The global financial landscape is changing, and those who recognize these changes and act proactively will be better positioned to protect and grow their wealth. Gold and silver offer a reliable hedge against economic instability, providing a foundation of stability in an uncertain world. For American and allied viewers, the strategic accumulation of gold by central banks worldwide should be a wake-up call. The diminishing trust in the U.S. financial system and the increasing debt obligations pose significant risks. Diversifying into physical gold and silver can provide a hedge against these risks and offer long-term financial security. This strategy is not just about preserving value, but ensuring stability in an uncertain world. Stay informed, diversify your portfolio, and safeguard your wealth with strategic investments in precious metals. Understanding these global shifts and positioning yourself accordingly is crucial for protecting your financial future.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.